Today, I want to talk about a straightforward method to estimate the current value of a property by looking at the income it could generate in the future. This method is called discounted cash flow analysis, or DCF for short. It's a key concept in real estate finance that helps us understand how much a property is worth based on its potential to produce income over time. Think of it as a way to translate future earnings into today's dollars, giving us a clearer, more precise picture of value. I'll break down how DCF works and why it's such an important tool in real estate investing. When we talk about discounted cash flow or DCF analysis, the key idea is that it ties value to future income rather than just today's price tag. This means instead of focusing solely on the current market price, DCF looks ahead to the cash a business is expected to generate, giving us a more comprehensive view of its worth. Another important point is that DCF allows us to compare deals on a consistent, risk-aware basis. By factoring in the risks and the time value of money, it provides a standardized framework for evaluating investment opportunities. It also helps reveal whether the expected growth really justifies the purchase price. Sometimes a company might look expensive based on current metrics, but when you project future cash flows and discount them, it might actually be a good deal, or vice versa. So, why does this matter? DCF helps you see value before the market does. While prices today reflect current sentiment, DCF is forward looking. It gives us a better lens to assess a company's true potential, helping us make more informed investment decisions. When we break down the discounted cash flow model, it really comes down to three key pieces that make the whole process work. Think of DCF as three simple building blocks, rather than one big complicated formula. First, we have the cash flows. This represents what the property is expected to earn over time. More specifically, it's a projected annual net cash generated after accounting for income and expenses. This is our input one. Next is the discount rate. This is the rate we use to convert future dollars into today's value. It reflects several important factors: risk, the opportunity cost of capital, and uncertainty about the future. This is a return investors require for the risk and timing involved. This serves as input two. Finally, there's a terminal value, which estimates what the property might be worth at the end of the forecast period. This captures the resale value or continuing value of the property, giving us input three. Together, these three inputs allow us to take future income and translate it into a present value, helping us understand the true worth of the investment today. When projecting future cash flows for a property, the first step is to estimate its yearly income and expenses to determine the net cash it could generate over time. We begin by telling the money story, starting with forecasting income. This means looking at rent, other revenue sources, vacancy rates, and making realistic growth assumptions for each year. Next, we subtract operating costs, which include taxes, insurance, repairs, management fees, and reserves. This gives us the net operating income. Then, we take into account capital needs like leasing costs, tenant improvements, or major upgrades to arrive at the actual cash flow. It's crucial to keep all these assumptions realistic to create an accurate projection of the annual net cash flow. Our goal here is to have a clear, well-founded cash flow projection that supports sound decision-making. Now, let's move on to step two, which is determining your discount rate. The discount rate represents the return an investor expects, taking into account the time value of money, risk, and uncertainty involved in the deal. Essentially, it's how much compensation investors want for the risk they're taking on. The more risk there is, the higher the discount rate needs to be. A higher discount rate, in turn, lowers the present value of the investment because future cash flows are discounted more steeply. Think of the discount rate as comprising two main parts. First, there's the risk-free rate, which is a base return you would expect from a completely safe investment, like government bonds. On top of that, you add a risk premium, which compensates investors for the additional uncertainty and risk involved with the specific investment. So in summary, the discount rate equals the risk-free rate plus the risk premium. This rate is critical because it reflects how investors price risk, influencing how much an investment is worth today. Now we move on to step three, calculating the terminal value. This is a crucial part of property valuation because it represents the value of property at the end of the forecast period. Generally, the investment continues to generate value beyond the typical forecast horizon, like year 5 or year 10. So capturing this future value is essential. There are two main methods to calculate terminal value. First, the perpetual growth method assumes that the cash flow keeps growing steadily at a constant rate. The formula here is the cash flow in a year after the forecast period divided by the difference between the discount rate and the growth rate. This method works best when the asset has stable long-term income and a realistic assumption about growth. The second method is the exit multiple approach, where you estimate the resale value based on market comparisons. You take the EBIT of the property at the end of the forecast period and multiply it by a credible exit multiple derived from market transactions of similar properties. This method is often reliable when there are good data points on comparable sales. It's important to note that the terminal value often accounts for the majority of the total value, so getting this step right is essential in any valuation analysis. This completes the three-step process for property valuation. Now, let's put everything together with the full discounted cash flow formula. The value of an investment is essentially the sum of each year's cash flow, but each cash flow is discounted back to the present value. This means we take each cash flow, divide it by 1 plus the discount rate raised to the power of the year number, and add them up. On top of that, we also take the property's terminal value, which represents its value at the end of the holding period, and discount that back to the day using the same method. By combining these elements, we get a comprehensive picture of the investment's present value. This formula captures the essence of what makes the DCF method powerful. It brings future cash inflows into today's terms, allowing for a clear assessment of value. Here we have a real-world example involving a multifamily property, specifically a 24-unit apartment deal. The goal here is to understand how rent, timing, and resale assumptions come together to determine the property's present value. Let's look at the key assumptions driving this analysis. The first year's net operating income, or NOI, is projected at $420,000 with an expected annual growth of 3%. We're applying an 8% discount rate, which reflects the required rate of return to account for risk and the time value of money. The property is held for a 10-year period, with an anticipated sale at that point. At sale, we assume a 5.5% exit capitalization rate, which helps us estimate the resale price. Putting all these assumptions into a discounted cash flow model gives us a present value of about $6.1 million. This figure represents what the property is worth today, considering both the future income it will generate and the proceeds from selling it after 10 years. Importantly, this isn't just about the rent income today. It's a comprehensive valuation that captures the property's potential over time. This slide demonstrates the concept of sensitivity analysis using what-if scenarios to show how small changes in key assumptions can significantly impact the value of an investment. Here, we look at variations in the terminal growth rate and discount rate to understand their effect on the illustrated property value. You'll notice that as we adjust the terminal growth rate from 2% up to 3.5% and similarly shift the discount rate from 7.0% to 8.5%, the property value changes quite noticeably. For example, with a lower discount rate of 7% and a terminal growth rate of 3.5%, the value peaks around $25.7 million. In contrast, when the discount rate increases to 8.5% and the growth rate is at 2%, the value drops to about $18 million. What this tells us is that even slight shifts in these key assumptions can have a big impact on valuation results. This kind of sensitivity analysis is crucial for making informed decisions, as it allows us to understand the range of possible outcomes and the risks involved. The base case value here, $21.3 million, represents our central estimate using baseline assumptions. By testing these what-if scenarios, we gain better insight into how robust the investment is under various market conditions. Overall, sensitivity analysis helps us prepare for uncertainty and manage expectations effectively. On this slide, we're focusing on some common pitfalls you might encounter and how to avoid them. First, underestimating risk is a big one. To manage this, make sure you use a discount rate that accurately reflects the uncertainty involved. Next, overly optimistic growth assumptions can lead to disappointing results. To prevent this, base your ground rent and exit assumptions on real market comparables. Ignoring market cycles is another trap. It's important to stress test your model by considering scenarios like slower leasing, changes in cap rates, and slower property sales. Lastly, missing real costs can seriously derail your planning. Always include expenses like downtime, reserves, fees, and future capital needs to get a realistic picture. Keeping these points in mind will help you make more informed, reliable decisions. When valuing a property, it's important to understand that each method offers a distinct perspective. The discounted cash flow, or DCF method, is the most forward-looking of the three approaches we're discussing today. It estimates value based on projected income over time, using yearly cash flow projections and applying a discount rate that accounts for risk and the time value of money. This makes it ideal for investors seeking a deep, detailed analysis to inform complex investment decisions. On the other hand, the cap rate method provides a quicker estimate by looking at 1 year of stabilized net operating income. It offers a snapshot of current income performance and assumes that the income remains relatively stable. This approach is perfect for speed, allowing for fast comparisons across the market without getting into long-term projections. Lastly, comparable sales look at what similar properties have recently sold for. This method is anchored in actual market transactions and is incredibly useful for understanding the pricing context and confirming the reasonableness of properties' value. However, it relies heavily on having truly comparable properties available. In summary, while these methods use different lenses, they're all trying to answer the same question: what is a property worth? The DCF method provides the deepest insight into future value, making it indispensable for thorough investment analysis. Let's review the key takeaways from our discussion on discounted cash flow, or DCF. First, DCF converts future property income into today's value, helping us understand what an investment is really worth right now. The process starts with realistic projections of cash flow, because if those estimates aren't accurate, the value won't be either. The discount rate is crucial. It accounts for risk, expected return, and the time value of money, reflecting how uncertainty and the waiting period affect value. Often, the terminal value represents a large portion of the total valuation, so it can have a big impact on your conclusion. Small changes in assumptions like growth rates or discount rates can cause big swings in the final value, so it's important to be cautious and thoughtful. Finally, remember that DCF is a decision-making tool rather than an exact prediction. Use it to guide your choices, not to expect an exact number. Keeping these points in mind will help you apply DCF effectively in property valuation.